There's one question everyone's asking about the car market right now. Why does buying a car still feel harder than ever? On paper, things look better. Factories are producing again, dealerships have cars on the lot, and prices aren't climbing as fast as before. But the reality in 2025 tells a different story. In this video, we're breaking down 5 key trends that explain what's really happening in the car market this year, from rising loan payments and growing inventory to new tariffs, negative equity, and delinquencies. By the end, you'll see exactly how all these pieces connect to shape the car buying experience in 2025. Let's rewind for a moment. After 2020, the auto market went through one of the most volatile periods ever. Factory shutdowns, supply chain issues, and the global chip shortage caused automakers to cut production. Meanwhile, stimulus checks and remote work boosted household savings, so more people went out to buy cars. The result? Prices exploded. By 2021 and 2022, paying thousands of dollars over MSRP had become normal. Used cars were sometimes more expensive than brand new ones. Now fast forward to 2025. Supply chains are mostly back to normal, production has ramped up, and demand looks different. But affordability, that's where things have shifted the most. Let's walk through what's actually happening across the market. The first big story in 2025 is financing costs. Even though the Federal Reserve has slightly lowered benchmark rates, average auto loan rates remain high. According to Experian, the average rate for a new car loan in early 2025 is about 6.7%, and for used cars, it's around 11.9%. That's roughly double what buyers saw in 2021. As a result, the typical monthly payment for a new vehicle has reached about $739, according to Edmunds data, up from around $600 just a few years ago. According to Cox Automotive, buyers now have to spend about 42 weeks of income to pay off a new car. So even though car prices have begun to stabilize, many buyers feel like affordability has actually gotten worse because borrowing costs eat up more of each payment. Loan terms have also stretched. Experian reports the average new car loan term is now about 68 months, with many extending beyond 6 years. Longer loans keep payments manageable, but increase total interest paid over time. And that has a ripple effect. Buyers spend more of their monthly income on cars, leaving less flexibility for insurance, maintenance, or emergencies. When we combine this with the next factor, you'll see why dealers are starting to face a different challenge. After years of shortages, we've now swung the other way. New vehicle inventory is piling up. According to S&P Global Mobility, as of mid-2025, U.S. dealerships held about 2.8 million new vehicles in stock, which equals roughly 70 to 80 days of supply. For context, a healthy supply in the industry is usually around 60 days, so we're well above that. Why is this happening? A few reasons. Production has normalized, fleet demand slowed, and high financing costs are pushing some retail buyers out of the market. To move cars off lots, automakers and dealers are increasing incentives. J.D. Power reports some manufacturer incentives reached 7.7% of transaction price by mid-2025, the highest in several years. Even with those incentives, many brands are still sitting on more stock than they'd like. Automakers like Ford have inventory stretching past 100 days for some models, while Toyota and Honda remain tighter at 20 to 40 days. So across the country, lots are fuller, promotions are more common, and dealers are juggling how to maintain profits in a higher cost environment. The next factor takes us beyond dealers and into trade policy, something that's quietly reshaping prices and supply chains. A major storyline this year has been tariffs. In early 2025, the U.S. government imposed new tariffs on imported cars and auto parts from multiple regions. Imports from Mexico now face tariffs up to 25% and Canada between 10 and 25%. These policies are meant to support domestic manufacturing, but they've had a real impact on pricing. Analysts from Kelley Blue Book estimate that tariffs have added anywhere from $2,000 to $5,000 to the average price of affected vehicles, especially pickups and SUVs built in Mexico and Canada. Meanwhile, automakers are adjusting supply chains, shifting some production to U.S. plants to offset costs, though that takes time. So far, we've talked about pricing and supply, but there's something happening on the consumer side that's just as important: how much people still owe on the cars they already have. This brings us to auto loan equity. Negative equity happens when someone owes more on their loan than the car is worth, and that's become increasingly common in 2025. Data from Edmunds shows that in the second quarter of 2025, about 28% of trade-ins toward new vehicle purchases carried negative equity. That's the highest share in over 4 years. This trend started with the inflated prices of 2021 and 2022. People bought vehicles at peak prices, often financed for 6 or 7 years. As prices cooled and interest rates rose, many of those loans fell underwater. Here's what that looks like in practice. If someone bought a $45,000 SUV in 2022 with minimal down payment, by 2025 that vehicle might be worth $33,000 on trade-in, but they could still owe $39,000 on the loan. This situation makes trading in or upgrading difficult. Many choose to hold on to their cars longer, delaying replacement cycles. Others roll the difference into new loans, increasing debt levels overall. And that connects directly to our fifth point, how these pressures are showing up in delinquency data. Auto loan delinquencies are climbing. According to the New York Federal Reserve, the total outstanding auto loan balance reached $1.66 trillion in mid-2025, an all-time high. At the same time, more borrowers are falling behind on payments. Data compiled by Y-Charts shows that 4.99% of U.S. auto loans were 90 days or more past due as of June 2025, the highest rate since 2010. Subprime borrowers, those with lower credit scores, are seeing the biggest strain. Axios reported in March 2025 that 6.5% of subprime car loans were seriously delinquent, compared to about 4% the year before. Repossession data also reflects the pressure. Industry trackers estimate 7.5 million repossession assignments in the first 3 quarters of 2025, roughly 16% higher than 2024. So even as overall employment remains strong, higher costs, insurance hikes, and inflation in essentials are causing more missed payments. What's clear is that car loans are a growing burden for many households. Let's take a step back and look at what all of this adds up to. If you zoom out, the data tells a clear story. The frenzy of shortages and markups is over, but affordability challenges and debt pressures have taken its place. If you found this breakdown helpful, hit like and subscribe, and let me know in the comments what you're seeing where you live. Are dealerships offering more incentives, or are prices still holding firm? Thanks for watching, and I'll see you in the next one.